I tested two investing strategies with real money. Dollar cost averaging versus buying the dip. Same amount. Same market. Same time period. And what happened next, honestly surprised me. Because the winner wasn't just unexpected. It actually challenges how most people think about investing. And even more interesting. Some of the biggest investors in the world don't even agree on this. Most beginner investors get stuck on one question: should I invest consistently every month? Or should I wait for the market to drop and buy cheaper? Both sound logical. But in real-life investing, logic and emotions don't always match. So let's break both strategies down properly. Dollar cost averaging, or DCA, is simple. You invest a fixed amount at regular intervals. For example, every month you invest the same amount. No matter what the market is doing. Market goes up. You invest. Market goes down. You invest. Market crashes. You still invest. You are not trying to predict anything. You are just staying consistent. When prices are high, you buy fewer shares. When prices are low, you buy more. Over time, this averages your cost automatically. No stress. No timing. No emotional decisions. And this is exactly why many long-term investors prefer it. Now let's talk about buying the dip. This sounds smarter at first. You wait for the market to fall. And then you buy at a discount. Simple idea: buy low, sell high. But here's the real problem. What exactly counts as a dip? 5%? 10%? 20%? And what if the market keeps going higher instead of dropping? Or what if you wait for a better price? And the market never comes back down? Buying the dip looks simple in theory. But in real life, it requires perfect timing. And timing is where most investors struggle. Now let's look at what some of the biggest investors actually do. Warren Buffett has repeatedly said, backhand index pointing right, the stock market is a device for transferring money from the impatient to the patient. His strategy is not about timing dips. It's about staying invested for the long term. This aligns closely with consistent investing, similar to DCA. John Bogle, who created the first index fund for everyday investors, believed something very simple. Backhand index pointing right: most people cannot successfully time the market. His solution? Buy low-cost index funds and invest regularly. No guessing. No waiting. No timing. Just consistent investing over time. Now on the other side, hedge fund manager Paul Tudor Jones does try to time markets. But even he admits something important: backhand index pointing right protecting capital is harder than predicting markets. And he warns that timing mistakes can be extremely costly. So even for professionals, timing is not easy. A famous Charles Schwab study tracked different investing styles over 20 years. They compared perfect market timing, lump sum investing, dollar cost averaging, worst timing scenarios, staying in cash. The results were interesting. Perfect timing performed best, but almost nobody can do it consistently. Lump sum investing and DCA performed very close behind. But the worst performer? Staying in cash and waiting for the perfect dip. That strategy missed years of market growth. Here's what this tells us about real markets: markets don't move in predictable dips. They move in cycles. With growth happening over long periods. So every month you're out of the market. You might be missing potential gains. This is where DCA naturally has an advantage. It keeps you invested through all conditions. Now let's imagine two investors again. Both start with the same amount of money. One follows DCA and invests consistently every month. The other waits for a 10% drop before investing. At first, the market dips slightly. The dip buyer thinks, not enough. I'll wait for a better entry. But the market quickly recovers. Then goes higher. The dip buyer hesitates again, waiting for another opportunity. But that opportunity keeps getting delayed. Meanwhile, the DCA investor keeps investing no matter what, building position after position over time. By the end of the period, the DCA investor is fully invested and exposed to all market growth. The dip buyer has spent a large part of the time waiting, missing multiple recovery phases along the way. And that's the key insight: it's not that buying the dip is wrong. It's that execution in real time is extremely difficult. This leads to one simple truth: most investors don't fail because of bad strategies. They fail because of emotions. Fear when markets fall. Hesitation when markets rise. And patience that runs out at the wrong time. To be clear, dollar cost averaging is not perfect. And buying the dip can work very well, if you have discipline, experience, and timing skill. But for most people, consistency is far more reliable than prediction. Investing is not about finding the perfect moment. It's about staying in the market long enough for time to do the work. Because in most cases, time in the market beats timing the market. Have you ever tried waiting for a market dip? And what happened when you did? If you found this helpful, subscribe our channel for smarter investing insights.